Welcome to our in-depth tutorial on financial risk management. In today's volatile financial markets, managing risk is crucial for protecting your investments and ensures sustainable growth. Let's dive into the essence of financial risk management and explore various strategies with real-world examples. Financial risk management involves identifying, analyzing, and taking steps to mitigate or manage exposure to risk. This process ensures minimal impact from unforeseen financial events. There are several types of financial risks to consider. These include market risk, credit risk, operational risk, liquidity risk, and reputational risk. Each poses a unique threat to the stability of investments and requires different management strategies. Market risk refers to the possibility of an investor experiencing losses due to factors that affect the overall performance of financial markets. For example, changes in interest rates, currency exchange rates, or commodity prices. A classic example of market risk is the 2008 financial crisis. During this period, the stock market plummeted, which resulted in massive losses across various sectors. Investors who had diversified portfolios were able to mitigate some of these losses. To manage market risk, one can employ strategies like diversification, hedging, or using options and futures contracts. Diversification across different assets and sectors reduces the impact of any single asset's poor performance on the overall portfolio. Credit risk is the risk of loss due to a borrower's failure to repay a loan or meet contractual obligations. This is especially pertinent to lenders and bondholders. A key indicator of credit risk is the credit rating of a borrower. For instance, during the global financial crisis, many borrowers defaulted on their mortgage payments, leading to significant losses for banks and financial institutions. This emphasized the importance of assessing credit risk accurately before lending. One way to manage credit risk is to conduct thorough credit assessments and maintain credit exposure limits. Another approach is to use credit derivatives or insurance to transfer the risk to another entity. Operational risk involves losses due to failed internal processes, people, systems, or external events. This can include anything from system failures, fraud, to natural disasters. A notable example of operational risk is the case of Barings Bank in 1995, where unauthorized trading by a single employee led to the bank's collapse. This highlighted the significance of robust internal controls and monitoring. To manage operational risk, organizations often implement strong internal controls, regular audits, and continuous monitoring of processes. Additionally, insurance policies can be purchased to cover potential operational losses. Liquidity risk pertains to the inability to buy or sell assets without a significant price change. It's essential during crises when the ability to quickly convert assets to cash can mean the difference between staying solvent or collapsing. During the 2008 crisis, liquidity dried up swiftly, and many businesses found it challenging to meet their short-term obligations. This underscored the need for maintaining a liquidity buffer. Managing liquidity risk often involves maintaining a portion of assets in highly liquid forms like cash or marketable securities. Companies might also rely on credit lines to ensure liquidity in times of need. Reputational risk is the potential loss to financial capital, social capital, or market share resulting from damage to a firm's reputation. It's increasingly significant in an age where information travels fast and reputations can be easily tarnished. Take the example of the data breaches that have plagued various companies. Such incidents lead to loss of customer trust and can have severe financial repercussions. To mitigate reputational risk, businesses must maintain transparent and ethical operations, respond swiftly to crises, and engage in positive public relations activities. Now it's time for a few questions to test your understanding. 1. What role do credit ratings play in assessing credit risk? 2. How can diversification help in managing market risk? 3. Name a strategy used in managing liquidity risk. Answers. 1. Credit ratings provide a measure of the likelihood that a borrower will default on their obligations. 2. Diversification helps to mitigate risk by spreading investments across various assets, reducing the impact of a single underperforming asset. 3. Maintaining a buffer of liquid assets or marketable securities. Thank you for watching this comprehensive guide on financial risk management. Effective risk management is about being prepared and proactive. By understanding and implementing these strategies, you can better safeguard your investments against potential risks.